and I would like to welcome you all to our event on financial preparations and Parkinson's. And I would like to introduce you to our first speaker, Bill Upson. He's a financial advisor, and he's written a few different books on long-term care, and he founded Strategic Asset Management Group in 1986, and he focuses on income and estate tax planning for high net worth individuals, business owners, retirees, and he's here to talk to you a little bit about long-term care and what that looks like.
Thank you, Lauren. What I'd like to talk about today are some of the issues that surround certainly what you're all dealing with in one form or another. And primarily my concern is to make sure that you realize that there are solutions out there even when people do have illnesses which normally preclude their getting coverage for, say, long-term nursing care, for home care, and for other types of services. So my purpose in talking today is to try and give you a wide-ranging set of viewpoints, not necessarily just mine, but those from our industry, the insurance industry, and also some input as to what's happening from a government point of view, whether it's good or bad. And most likely you've heard something, although it's probably been very limited, about what's called the Class Act, which is an act passed by the Congress in the past year or so with the intention of creating a long-term care program for all Americans. In the past 6 months, they've come to the conclusion that financially they can't do it. They cannot put together a program that will work. So unfortunately, what's going to happen is it falls back on each of us to take care of these issues ourselves. And what you're going to find is there are going to be more companies that are going to change the kinds of products they have. And the reason I hesitated when I said that is that many of the companies today have actually taken their products off the market. And they've taken them off the market for a specific reason. They have realized that the pricing and the type of services they've been trying to promise in these programs are more than they can afford and more than they can pay out in terms of their being in business 20, 30 years in the future. So what's happening is these programs are being pulled back off the marketplace and they're being redesigned. And they will be less robust types of programs, and they will be more expensive. And in some cases, many cases, coverage will be denied to those who are in situations where they already have a health issue. So we're going to talk about that. We're also going to talk about how we get around some of those issues. So hopefully, when you leave here today from my part of the presentation, you'll have a little better idea of what is possible in terms of a solution for you if you've not already taken care of it. Now, I spoke with a couple of the people here in the audience as they came in today who have already gotten coverage from one source or another, possibly years and years ago. You want to stay on top of what you have and make sure that if there is going to be a rate increase, a change in the benefits, an opportunity to buy more coverage, any of those things that could happen, just be aware that there will be changes. The entire industry is going through this right now. Having said that, each of you has pages from one of the books that I wrote, I think in your possession. And I'd like to just briefly go through those pages so you get an idea of the things that we look at when we talk about long-term care, when we try to help clients understand these issues. The book itself is called Long-Term Care, Alternatives and Solutions. When I wrote the book in 2000, I had no idea that I would become kind of a lightning rod for this kind of a situation because nobody was talking about long-term care 12 years ago. I had gone through it with my parents, and my dad had been the budget director for the state of New Hampshire. He had suffered a debilitating stroke, he had been blinded, and as a consequence, he and my mother lived in a farmhouse in New Hampshire. Well, the problem was she had heart disease, and we assumed that he would pass away from the stroke. But within 3 years, she was gone. And all of a sudden, I was dealing with a very angry person who was blind. And one of the side effects of strokes can be this kind of an effect, this anger. Not only that, but he was also a master sergeant of the U.S. Army during World War II, and he never failed to Tell me about that. But as a budget director for a major state government, he was a person who had some authority and power and understood money and all of these things, and yet he had done no planning whatsoever for long-term care. So in the grand scheme of things, I got up to speed very quickly because as a financial advisor, it was something I thought, gee, nobody is talking about this. Now this goes back 20 years ago. Today, just about everybody's talking about it and wonder why. We're all getting older. And as we get older, we have all of these additional problems. Now when I say to you, everybody should have long-term care, I absolutely mean it. Because if we all had it, we spread the risk. And as the money comes in, it allows everybody to get some level of coverage. That's the ideal world. The real world is we're dealing with an event that is in the future, that is hard to identify, that may not happen to you, but the likelihood, as you see on pages 2 and 3, is extremely high that it could happen. And in this audience in particular, there is a higher incidence of that already occurring than most of the audiences I speak to. So when you look at this material today, try to keep in mind we're trying to address this in a general sense for everybody's benefit. And it's not just because I'm talking to Parkinson's today. So when we talk about pages 2 and 3, that's what we're referring to as the likelihood, the possibility of that kind of a problem occurring, and the cost. I had one client several years ago come in, and she incurred in 1 year a cost of $1 million to care for her spouse before he passed away. Now, I'm not here to try and scare you because nobody could have ever planned ahead for something like that. But he had a series of events that caused that to happen. It is not at all unusual to see costs for people going through long-term care events to spend hundreds of thousands of dollars. And that's the kind of advanced planning work we do to try and make sure that when the event occurs, we've got the coverage in place to at least offset some of that, to adjust for it, to provide good tax planning, to look at government programs that are available. Now, I would imagine that some of you are military veterans. I would encourage you to look to the Veterans Administration, because even though my father was told he was not entitled to benefits at the time, and several of my clients have been in similar situation, by pushing against the door, we have been able to get people benefits that they initially were told they were not qualified to receive. The same is true of Social Security. We have come across situations which absolutely surprised us. We did not realize that there were these kinds of possible ways to get at benefits. So if you have not taken the time or thought you weren't qualified, please take the time to check with the local offices, and if you don't get a result you like, look further. Because one of my clients spent almost a year getting veterans benefits he was entitled to because he was exposed to Agent Orange during the Vietnam War. And he was told repeatedly by the VA he was not qualified. But at the end of the day, after he'd given up, 3 months went by, he got a letter out of the blue. And in the letter it said, "We are starting to pay you $3,000 a month, allowing you to have access to prescription drugs and giving you coverage for long-term care for the rest of your life." And he was a person who, a captain in the U.S. Army, successful businessman, he never ever thought that he'd be using government benefits. But this made a huge difference in his life. So let's just move along quickly. Page 30, the page numbers are at the bottom of these copies that you have. That page talks about Medi-Cal. On the federal level, it's called Medicaid. And that is for welfare benefits primarily. So if you have lost most of your assets or given your assets away, and there are a variety of ways that that does happen, then those benefits are available to individuals here in the United States, both U.S. citizens and otherwise. Medi-Cal is the problem that we have in this country in terms of trying to provide enough funding for this kind of a problem. And I say this piece of the pie. We have Medicare. Medicare many people are on now, which is medical insurance. But Medicare does not cover long-term nursing care or long-term home care other than for skilled nursing purposes, unless it's an unusual set of circumstances. and they only cover for approximately up to 100 days. And there are deductibles, and they change year by year. So you want to stay up to date on that kind of information. Page 51 talks about association plans and group long-term care coverage. When I wrote the book, the group long-term care market was very robust, and we were able to get many people covered who had serious health problems. During the past 6 months, maybe 1 year, several major companies have left the market completely, and it's becoming very, very difficult to get people covered under a group program. Group simply means no underwriting, no questions asked. Whatever your health is, you'll get a policy. Those policies are just going away now. Association plans were also another way of doing this. And as insurance agents, we were always trying to find ways to get our clients covered. Those are going to become very difficult to find also. If you think you're going to go looking, look quickly, because once the programs go away, they will not be offered in their current form again. And when I say go away, I don't mean that if you bought a policy, they can take it away from you. Long-term care insurance, once it's issued and once you've paid for it, they can never take it away from you. So I want to make a clarification so there's no misunderstanding there. Pages 63 and 64 talk about issues such as life insurance with long-term care riders. It talks about annuity products with long-term care riders. And it also will be addressing in more detail, as we update this information, one of the new government programs that allows you to take monies from a qualified retirement account, such as an IRA. If you have the monies in an annuity, one of these new generation annuities created after 2010, that will allow you to take money out for long-term care purposes without paying or being subject to income tax on the monies taken out. This is a major change, and it has a tremendous effect on people who have had their monies locked up in IRAs, not wanting to take the money, and not having a way to get it out without paying tax. So this is a solution, but it's very complicated, and there are very few companies that are offering it right now. If in fact you have interest in this area, we'd be more than happy to talk to you. The phone number for my business, I'm going to give it to you, but you can also get it off the calendars, which I'll tell you about in a moment. The number is 800-765-0561. On page 66, we talk about veterans benefits, which I've already alluded to, so I'm going to pass right over that. Pages 76 and pages 77, I wrote a chapter in the book, and the title of the chapter is Insuring Your IRA. Now the reason I did that is because 5, 8, 10 years ago, people would say, well, there's no way I can have insurance inside my IRA, no way I can protect my IRA. You can, in fact, insure an IRA. You just have to go through a series of steps to make that happen. And you can have the policies paid for under some circumstances inside the IRA. Now, there are unique types of policies. They can be life insurance with long-term care riders, which are held outside of the annuity, outside the IRA, but paid for by the IRA. You can have annuity products inside an IRA account, which can provide benefits when needed for long-term care, as well as income in later years. And you can have a variety of subsets of those. So over the years, we created all of these different ways that we help solve these problems. That chapter addresses all of that information. And it addresses it in such a way that pictorially you can see what we're trying to explain. Now, as far as the books go, you can purchase the books online through Kindles, through iPads, through Amazon.com, and the books themselves have a very robust set of information concerning these issues. Price on the books is around $5 a piece. Portions of that money go to the Parkinson's Institute for research purposes. Page 85, we talked there just briefly about traditional IRA accounts versus Roth IRA accounts. One of the reasons you might consider converting part of your money from a traditional IRA to a Roth is because the Roth monies, once converted, can be used to pay for long-term care premiums, for any of those kinds of expenses without tax consequence. Another issue that is in this same venue is if you have a financial advisor you're working with, take the time to ask them to look through your income tax return, because there are many ways to reduce your overall income tax liabilities. I've been successful in getting people's income taxes down from $35,000, $40,000 a year, the taxes, down to zero. And I've done it repeatedly for certain clients over the years. I've had IRS agents actually look at the returns and agree that everything we did was above board. None of the gray things you hear about out there. But there are ways to bring your tax liabilities down so you have more spendable money to solve the problems of your day-to-day lives. Page 103. We just briefly addressed the issue of trust and the concept behind using trust for things such as special needs planning. Now, when I first started working in that area, it was to try and protect disabled children's accounts from the government grabbing those monies and no longer having the ability to use those funds for special things that they wanted to do for their children. But a special needs trust, for those who don't know what they are, a third-party trust is a special needs trust when structured properly and allows the individual who is putting money into that trust to know the monies will go for the benefit of the disabled person. And at the passing of that person, the money then passes on to the next generation or other family members. If you don't have this type of trust and you just give the money to that disabled person, the government has the right to take that if, in fact, you're on benefit, either through Social Security, disability, or through Medicare, where they're making payments before you normally would access those benefits, say, prior to age 65. I'd like to just give you a thought here on page 130. When I started doing the research for this 10 years ago, I was traveling in the Far East, and I happened to be in the U.S. Embassy. And I got some material that really, truly surprised me, because they were addressing the problem more frequently in that part of the world than we were here. And it wasn't because the populations were older, it was because they were going through population changes that were not being discussed in this country. In Japan, I'm going to use them as an example. Japan has what is called a declining population because their population is indigenous to the islands and they discourage immigration. What takes place is the number of people being born to replace those passing away is declining. And their population topped out about 2 years ago at about 127 million, up from roughly, I think it was about 85 million back around 1950. Current projections have it that they'll be back down below 100 million by the year 2100 or sooner. Well, what does that mean? It means that they don't have the financial horsepower from the younger population to continue the benefits for the older population. And on a country-by-country basis, it can be a very serious problem. The opportunity, if it's an opportunity in this country, and we hear this about immigration all the time, is we keep enhancing, we keep adding to our population base. And as we do that, we keep adding more taxable revenue to the overall, what is the overall effect on older people. So we have a different set of circumstances. But we have to realize that across the world, in the next 50 to 75 years, out of a population of probably 8 billion, over 2 billion will be over 65 years of age. So we're looking at a problem that's getting larger and more massive and more expensive as we go forward in time. The last page that I want to direct your attention to is page 139, and it talks about the California Partnership. The California Partnership was a very unique program put together by the state of California with 6 major insurance companies. And unfortunately, the insurance companies, one by one, had pretty much left the market. But the idea was to create a very robust, very complete long-term care product, and the state of California would actually help to sell the product to the public, because it was in the best interest of the state to have you buy a policy rather than falling onto the financial benefit that would be provided by the government, which they didn't have. So the program is a very good program. There's still policies available. And for the spouse that is not incapacitated, these policies should be purchased. And I say that unequivocally because they have asset protection as part of those policies. So I have gone through and covered a great deal of material very quickly. I am going to open it to questions, and I don't want to impinge upon the next speaker, but I just wanted to let you know those are the thoughts that I had today that I'd like to share with you. Any specific questions that I might answer at this time? Yes, ma'am.
I wondered if you could say more about income tax returns to reduce tax liability.
I would suggest to you very strongly that you take your income tax return if you're working with a financial advisor or your CPA or your tax preparer and have them go through after tax season, because this time of year is terrible for them, but after tax season, go through and have them explain some of the areas where you can reduce your taxes. As an example, I've used the word annuities several times during the conversation today. Many people have their money invested in things like mutual funds, managed accounts, CDs, money market accounts. There is absolutely nothing wrong with any of those investments. But every one of them creates a taxable event of some consequence every year. Good or bad, it creates a tax consequence. It requires having additional paperwork filed with the tax return. It causes extra taxes. If you had the money inside an annuity product, an annuity has a wrapper that prevents any current taxation. The money still grows inside the annuity contract, but you don't pay taxes until you take the money out. And there are various ways to reduce down your tax liabilities using tools like this. Does that help?
It'll sink in eventually.
She said it would sink in eventually. Taxes do that to you. Unfortunately, they can hurt too. Yes, ma'am.
My understanding was that annuity products were not inheritable. Is that not correct?
When you talk about inheriting an annuity product, you are correct. In most cases, annuities are meant for the lifetime of the existing individual or for a husband and wife. But annuities of the current construction, things that have been around for the last 10, 15, 20 years as new products, when you pass away, the monies that are in that annuity still pay out to your estate. And those monies can be then passed on to the next generation. So you may be thinking of annuities like police officers and nurses and fire personnel had years ago, where if you died, you lost the money. That is not true anymore. And even the products that police, fire, those types of organizations have certain death benefits attached to them. The use for an annuity is multifaceted because it does have these long-term care benefits, it does avoid current income taxation, and it does provide you the ability to move your money back and forth to various sub-accounts within the annuity, different types of investments, bonds, stocks, mutual funds, different types of things without paying tax every time you take the money and make a transfer. They are not simple products, and I'm trying to simplify it just for purposes today. You really need to sit down with your advisor and make sure you understand it. They have costs involved. Every product out there has costs. Annuities are probably one of the more expensive ones. But when you avoid taxes and you do it for multiple years into the future, taxation is one of the things that drives us down in terms of building our wealth over time. Life insurance is the same kind of product. Whether you like it or not, money in a life insurance policy grows tax deferred. If you pass away, the benefit paying out to the next generation is 100% income tax free. There is no tax on the money. I alluded to life insurance with long-term care riders a moment ago. Those riders can pay out a long-term care benefit during your lifetime that is income tax free. I'm only trying to spike your interest here. I'm not trying to explain the entire product. The question has to do with continuing care communities, and if that is an unusual term for you, it applies to paying money up front and then paying so much per month for the rest of your life, and they care for you for the rest of your life. And if you passed away unexpectedly, in most cases, they would keep a portion or all of the money that you paid in. Depends on the circumstances. My concern has been, and so has the concern of many people been, how strong are these institutions? Because you're putting your money into something where 10, 15, 20 years in the future, they're promising benefits that they may or may not be able to provide you. So the question really is, should I have long-term care coverage in addition, just in case? And I think that would be an excellent solution if you can afford to do both.
Can a person diagnosed with Parkinson still get long-term care?
We have been successful in getting people covered with long-term care coverages. I'm not going to say a long-term care policy, because normally a long-term care policy, one of the first questions they will ask is, are you suffering currently from cancer, from heart disease, from Parkinson's, MS, illnesses like that, and those are automatic declines. They will not provide coverage. But there are policies and products out there which do have guaranteed issue elements in them. So talk with your advisor or give us a call. We can go through them in detail. But there are ways to get around this issue. I'm not saying we can solve 100% of the problems. We can't. But many times I've been successful, probably 70 to 80% of the time, in getting people some form of coverage to increase the amount of benefit they would have in the future. Yes, ma'am.
Twofold question. Number one, if you're well advanced in age, then getting long-term care is prohibitive financially to be able to afford the payment.
Her question had to do with your age and getting coverage, and I would tend to agree with you. As you get older, the cost for coverage becomes dramatically higher. The oldest individual I ever covered with a policy was a 92-year-old. And believe me, it was very expensive. He was spending in the neighborhood of about $15,000 a year, but he beat the insurance company. He went on claim a year later, lived 4 years, and got all his money back and then some. So I'm not answering your question. It is very difficult. It can be very hard to get it at the older ages. If you get over the age of 80, 82 years of age, it's going to be very close to impossible to get pure long-term care insurance coverage, even if you're healthy. Annuity products will go up to age 85 in some circumstances with a long-term care rider in certain situations. But you are correct. And your second question?
You mentioned a book. What's the citation of the book?
The book that I wrote is, the cover page of those materials you have is Long-Term Care, Alternatives and Solutions. And that book is available online. And you can go to longtermcarebooks.com or strategicasset.net. Either one of those sites will get you to the books. And if you can't find it, by all means, give us a call. We'll be happy to help you with that. You can download the books into any of the electronic media toys that are out there these days. We also have it in hard copy. Okay? Thank you very much.